Thank you for joining us today. I'm going to let some people roll in here, so just give it another 30 seconds and we'll get started. Okay, well, we're going to get started now. So thank you everyone for joining us today. I have on the web call today with me, Greg Mance from One America. Hello, Greg.
Hey.
Greg's going to be talking about using non-qualified money for their hybrid product. And we had Greg on actually about, a couple months ago, where he talked about using qualified money and how you can do that. This product is super flexible and versatile. The way it works, it's awesome. I think it's the most competitive product in the market, just in terms of the leverage it provides and also the flexibility that it allows for clients. And so Greg's going to be talking about it more from the non-qualified side today. Greg has been with One America since 2019. He is a certified financial planner. Congratulations, Greg. And has been in the industry since he graduated from Concordia in 2006. Greg has worked with ING Voya. I actually worked with Greg for a few years. That was like 7 years ago. Now 7 years is like 5 minutes when you get older, you know. It's a part of old man syndrome. And he worked at Thrive in the past, and he's worked in many areas of the industry, including life insurance, annuities, financial planning, and of course, long-term care. And Greg partners with advisors to help them with their long-term care business needs at One America. He is always available as a resource to help advisors, strives to be a regional contact for advisors, and he is a 2-time Eagle Award winner for the #1 territory within One America. Congrats, Greg. That's a pretty cool honor. So Greg's been around for a while. He knows his stuff. He's going to be talking about the product today. And Greg, with that, why don't you get started?
Awesome.
Oh, by the way,
Wade.
let me just throw in there really quick. If you guys have questions, by the way, at the bottom, the question box, you can just type in there and we'll answer those kind of as we move along here. So sorry about that. Go ahead, Greg.
All good. Thanks, sir. Good. Thanks for having me back. I appreciate it. Usually I do these once and nobody wants me back. So
it's a good sign. It's a good thing.
Yeah. No, I'll just say I worked with Wade for a number of years and love working with Wade. I'm sure you guys all do too. Wade's great. He's awesome at his job and it's a great dude. So thanks for having me again. Really appreciate it. What we're going to talk about today, everybody, is we're going to talk about how we can efficiently use non-qualified dollars to fund long-term care. So I know a lot of us on this call. I know a lot of us work primarily in the Medicare space, rather, along with number of other things. Why I think this is so important today is, if I said a blanket statement, we've had some changes in the Medicare business. I don't think anybody would be surprised by that statement. I've talked to a lot of you as well, and I know that you've seen significant decreases in your revenue as a result of a lot of the changes. So what I'm hearing from a lot of advisors is that we have to make that revenue up somehow, right? We have to do something different. And if you are in that space, you have the perfect opportunity. It's kind of a perfect storm because you have the right clients. You've got large books of older clients that are interested in this. You might be working with their kids already. So it's just about getting yourself comfortable with a different product line. Wade's here to help you with that. I'm here to help you with that as well. And my goal today is to help you identify at least a couple people that you can go talk to right away. So I'm going to talk through a little bit about how everything works. I'll talk about some different options we have. Again, we'll focus on clients that you already have. And we'll be 15-20 minutes, and then we'll take questions. So let me stop chit-chatting, and I'll get started with the presentation. So what I really want to start with, though, and I think this is really the most important part. This is the key. Is One America as a company. People ask me all the time, what's your greatest strength? And hey, as Wade said, we've got some really unique products. We have some really unique niches. We have a number of ways to fund these that we'll talk about today. But ultimately, you know, insurance is about a company keeping its promise and helping customers when they need help. That is our greatest asset at One America. We have a long history in this business. The idea of asset-based long-term care, the whole thing started with One America. One America was the first company to kind of link up life insurance and long-term care. So we have more history in this business, more experience than anybody else does. We're a highly rated company. Our Comdex is 95. We're a mutual company. You know, so I've always said, again, at the end of the day, the most important thing of any insurance product is the company behind it, the company that will keep its promises. And we've got a great reputation for paying claims. We have a great process with claims. You know, so I would just put that at the forefront, because everything we talk about today is kind of backed by us at One America, which ultimately, when your clients have to make a claim, they're going to be in their 70s or 80s, right? All of our claims are handled in Indianapolis in our home office. We have 40 claims professionals in our home office. And when somebody makes a claim, you know, we don't just throw them into an 800 number, into a queue, and they talk to the next person. No, they have a case coordinator. We call it a concierge that they work with. So let's just say it's Sandra, right? The family will call Sandra. They'll email Sandra. Everything will go to that one point of contact, and they will handle the claim throughout the whole process, which makes the claim process about as easy as you can. So we're very committed to this industry, and we've been doing it a long time. We're seeing overall a huge, I'm getting a note that we might have network issues. Is that true, Wade? Can you hear me? Am I chopping? Am I clear?
You're good. I can hear you. So you should be
Okay.
fine. I think there was maybe a little something on my end, but I think you should be fine.
Okay, just want to make sure. All right.
Yep.
So we're seeing an increased demand for long-term care insurance, and you guys might be as well. We have an aging population. We have the largest generation in history, the baby boomers. They're getting closer and closer to age 80. In fact, the first baby boomer turns 80 today, or it turns 80 this year. So we call this the silver tsunami. We have this wave of population that's getting close to this age 80. Well, why is 80 so important? Well, 80 is where, when we look at our historical claims, age 80 is where most people start to make a claim. 75% of our claims are age 80 or older. So if you think about it, you have this tsunami coming. They're knocking on the door of age 80, which means all these people are going to start to need care services. And what that means for you guys is it means we have some opportunities and some options to help some of those people, but maybe even more importantly, their kids are going to come back to you and they're going to say, you know what, mom and dad went through this and they didn't have a plan. You know, we've had to be caregivers, we've had to work with the providers, et cetera, et cetera. We need to make sure this doesn't happen to us. I'll bet if you've been around a while, you've had somebody come to you that says that same thing. And that's something that I think is going to continue to accelerate over the next couple of years. So I firmly believe this is the best time to be in this industry, just because of the amount of people that are going to come knocking on your door saying, hey, we need some help. When it comes to care, though, there's really just a number of ways that we can pay for care. Okay, so long-term care insurance is part of it. You can buy traditional long-term care. That would be, you know, again, your typical policy where you pay a premium and you get a benefit. Those have become less popular over the years. They're still great options. I mean, it is still the kind of the cheapest, most affordable way to get a benefit. I think that's probably the best option for people that can't really afford a better level of coverage. But they are, you know, there's still a lot of traditional companies out there. Not near as many as there used to be, but there are a number of good providers. You can also look at asset-based long-term care. And that's what we offer. Asset-based means you start with an asset. So you start with a life insurance policy or an annuity, and then you can leverage those dollars to create even more benefits. Nowadays, it's something like 8 out of 10 of the policies sold are asset-based long-term care. So it's definitely gotten to be more popular. It solves a lot of the problems that you have with traditional insurance, things like guaranteed premiums. You know, when you buy an asset-based policy, at least with One America, for sure, everything is guaranteed, so you won't get any increases. And then the other big problem or concern with traditional is you pay all this money in and you may not get anything on the back end. Well, with an asset-based policy, if you never use the care, you'll get that asset back via a death benefit for the beneficiary. So those are two options. But but unless you buy insurance, you're really on your own. You generally have to self-fund, which means you're using your own dollars to pay for care, and you self-fund down until you basically have very little money left, and then the government can take over through Medicaid or other sorts of programs, that maybe haven't been developed yet. Who knows what's going to be there in 20 years. But the point is, we see a lot of people that say, hey, I understand it's a risk, I understand it's a concern, but I'd rather just take the risk myself. And I always tell people that's fine. There's nothing wrong with that. But the question is this: how much of your own money are you going to spend in care? A lot of people like the idea of self-funding, bearing that risk themselves. They get to a point where they might start to need care, so they start giving away assets to kids, to beneficiaries, start using trusts, and that's all fine. But at the end of the day, that by default is the most expensive option. Isn't it a lot simpler to just simply buy some protection, and then you can have your estate, you can have your charitable wishes, everything go exactly the way that you want it to, instead of having this hurricane move through and tear things up.
Yeah, I would like to just add to that too, Greg. I get a lot of requests for different types of long-term care, and I think a starting point oftentimes is, well, just hey, show me some examples. So show traditional long-term care, show hybrid, show there's different ways, different products that are out there. But a lot of times, because the cost of care is expensive, I think it's important for people to know that. I mean, this is a great strategy for people to, if like to Greg's point, if they don't use it, they don't lose it because they get the death benefit, kind of funneling it back as a return of premium or more than a return of premium. But it's important, I think, to let them know too that, hey, if you look at the premiums of a policy like this, like with One America, relative to the death benefit and relative to the long-term care benefit, and Greg will go over this a little bit too, it's a drop in the bucket. I mean, what basically people are prepaying, discounted dollars for a much greater benefit. I think that's important and to discuss with your clients. So we'll show them, hey, you're getting leverage on this. And if that's something you guys want to talk about as well too, let me know, and I can kind of show you how to tee that up with clients. But it's important to know that, hey, this is a product that you will use in some capacity. It's not like it's just going to be lost. And the amount of leverage you get is pretty outstanding, actually.
Yeah, and I would even add to that too, Wade. People ask me a lot of times, oh, my client's worth $5 million, they need coverage. Well, I hear constantly that the people that actually are higher net worth prefer the coverage because it takes the risk off of them. They understand the leverage. It's kind of like, hey, we made it to the top of the mountain, let's protect it, right? We don't want this descent from the mountain to be completely unknown. Let's devote a small percentage of our net worth to covering this risk, and then just taking the risk off the table. And the more I do this, the longer I do this, I just kind of come back to this idea that, hey, if you have the assets to take the risk off the table, why wouldn't you do it? Why wouldn't you do it? So.
Right, that's a great point too. Yeah, there's not like, oh, this has to be for people that really need it, because if they have the money, the resources available, they can self-fund it. It's a way to protect those assets that they have, and instead, leveraging their dollars instead, getting a better to protect those assets.
Yep, that's right. So, okay, well, I want to talk a little bit about how you fund asset-based policies. So we've got a number of ways to fund these contracts. We've got more funding options at One America than anybody else does. And you can fund these in a number of ways. You can do a single premium, so just one time and done. A lot of people like the idea of that one-time premium and that's it. There's no right or wrong way to do any of these, by the way. They're all different options and they all have good uses in different scenarios. We can do recurring premiums. So that's like a 5-pay, 10-pay, 20-pay. You can pay for life. That's actually become our most popular option, the pay to 95. I think the reason for that is it's just the lowest annual outlay, right? You pay less each year for the coverage. Now, yeah, you might end up paying more over your lifetime, but in any given year, the cost is a lot less. So it makes it more accessible to more people. And then for people that are advisors that manage money, you don't have to take such a big hit to your AUM. If you took $200,000 out of the market, well, that's $200,000 the client no longer is going to be able to earn interest on. It maybe makes a lot more sense to take 10,000 out per year, and that leaves the other 190 working for you in the market. And yeah, you might pay more for your coverage, but your money is going to continue to grow in this investment account. So at the end of the day, you know, you have more money, so it's kind of like you paid more for the coverage, but who cares? You have more money at the end of the day. So I think a lot of advisors really like that strategy. We also have the ability to do 1035 exchanges, so we can transfer old insurance policies to use those to pay for care. And maybe it pays for the whole thing, maybe it pays for a part of it, and you pay additional premiums on top of it, but we have a lot of flexibility there. And then the last time I was on here, we talked about qualified money. And we have a process that we've built to use qualified dollars in an IRA transfer to fund care. So I'll talk through some examples here. Again, I told you my job was to find you 3 people to talk to or 3 different clients. But let me just start with this. We did just recently change our underwriting process at One America. And you know, this changed in November of last year, and it has been way better than I would have imagined. Basically, we've automated a lot of stuff behind the scenes when it comes to underwriting. So what that does is it makes the process much, much faster for you guys and for us too. So if you have clients that are applying for long-term care, the way underwriting works is we will do once the application's received, we'll have them fill out some health questionnaires online. So they answer some health questions. It's all done electronically. So an email will go to the client where they can fill out the health questions. Once that's done, the health questions come back to us, and we run it through our algorithms and everything. And a lot of these cases, we're not even touching them anymore. So they're actually getting automatically approved. We'll do the background checks. We'll do everything behind the scenes as well, but it's all done automatically. And, you know, a lot of these cases where people truly are healthy, we get with what's called the straight through approval, which is kind of this first bullet point. And with straight through approval, you know, we're getting cases turned around in a day or two. We've had some that have taken like 10, 15 minutes. Wade, we had an advisor with IFC that took one on himself recently. I want to say he took an application on a Monday and he got approved on a Wednesday with him and his wife. I think we got it funded by that Friday.
Yeah, I remember that. Yeah, that was great. I've noticed. Yeah, like you guys have always been great to work with from an underwriting standpoint. It's great to be able to, you know, I can call an underwriter, talk to them, and have a conversation and find out kind of what's going on and get some of the details on that. But also the fact that you guys sped this along even faster is huge. So that's a huge benefit for you guys.
Yeah, and that advisor was mid-50s. So you know, our new process has been really good, and I've been really excited about that. We still will have people that aren't as healthy, so we'll have these other underwriting buckets we can throw them in, the light touch or the full underwriting. But even somebody that has to go through full underwriting and still has to do a paramed and everything, that process has been sped up by about 50%. So even people that are going through the full process, it's still being much, much faster. So I just share that with everybody because you know, if you have this fear that it's going to be this 3-month slog to get through underwriting, we've really sped that up and made that quite a bit better now. The way our products work is this. It's very simple. We've got a lot of different levers we can pull and things we can add, but at its core, it's very simple. We start with a 2-year benefit. So let's say you buy a life insurance policy. Let's just say it's $200,000 because the math works out really easy. So I buy a $200,000 policy. It can cover 2 people, both husband and wife. And the way that this works is your $200,000 policy, if you need long-term care, will be paid out over 2 years. So it's always roughly 4% per month of the death benefit. So in this case, you know, 200,000, we'd have about an $8,000 a month long-term care payment, a little bit higher. And then what we do is we can structure a rider on top of the base contract that keeps those payments going for longer. So we can either add an additional 2 years, an additional 4 years, additional 6, or we can do lifetime LTC. Lifetime LTC is by far the most common. We're the only company that does it in the whole industry. And I would say it's about 80% of my business, give or take. And the reason is it's the best coverage you can buy. It is more expensive, of course, but we can make sure that you don't run out of benefits. It will pay you benefits forever. If you have a 30-year claim, it will pay you for 30 years. And I think especially for higher net worth people, they see the value of that because you can't out invest a lifetime coverage. You just can't do it. You know, if you're buying a bucket of money, yeah, you could potentially grow your, if you bought, I don't know, spent 200,000 to get a $600,000 bucket of money, yeah, you could eventually grow the 200,000, you could eclipse the 6. But when you buy lifetime benefits, you can't invest your money to beat that. And so I just think at the end of the day, people see the value in that. And I would just urge you, if you're showing an option with us or another carrier, you should always show the client lifetime every time. Because if you have something in your quiver that is the best level of coverage, why wouldn't you at least show that to the client and let the client make that choice? My experience,
and the average, I'm sorry, I was going to say the average stay is getting longer too, right? I mean, it's
right. Yeah.
some people,
in my experience too, when I show clients, you know, I do a lot of point of sale stuff where I'll show them both, and almost every time somebody looks at the lifetime and they say, well, why wouldn't I do that? And you're like, exactly. It's more expensive, but they see the value in the lifetime.
Yeah.
Okay. Well, I'm going to just kind of scoot along here in the interest of time, and I'm going to say, I'm going to walk through 2 case studies, but really it's 3 clients here. So 3 people that you probably have in your book of business right now. You probably have clients with money sitting on the sidelines. That means people that have large lump sums of money in money markets or CDs or savings. Maybe it's money that was invested in the market and they got a little skittish, so they pulled some of the money out of the market and they set it on the sidelines, just waiting to see what happens. What's beautiful with our contract is you can take that, you know, a chunk of that money and you can just fund the policy, be done with it. Again, a lot of people love that idea. I'm going to share an example with somebody that's a higher income or possibly a business owner. And then kind of the third client that I know everybody has is somebody with existing life insurance. Now, you can take that life insurance policy they have right now, you can exchange it via 1035 exchange into one of our contracts, because one of our policies is life insurance. You just have this additional long-term care. So a lot of times you can better their situation, and depending on their cash value, that might be enough to pay the whole thing up, or you might be able to do the 1035 exchange and then do an ongoing payment as well to get you the level of coverage that you desire. But those are 3 people that I'll bet everybody has in their book right now, somebody that looks like this. So let's just talk about a couple case studies. So here I've got Bill and Sue, and Bill and Sue are in their 60s. They understand that LTC is important. You know, it's possible they've been through the process with their parents. They're probably at a point where they're getting their ducks in a row for retirement. The long-term care is always part of that conversation, and they have money on the sidelines. You know, it's kind of a joke, but I meet with a lot of people that have $200,000, $300,000 in checking or in their savings account because they're naturally conservative people. So they have a lot of money in these accounts, whether it's money market or CDs or savings or checking, sitting on the sidelines, and they're not really sure what to do with it, whether they're either so conservative that they want to just hold it in these savings accounts, or they're waiting for a better time to get in the market. One of the things that we can do is show them how they can take a piece of that and then redirect it to cover the long-term care need. I like the idea of using your assets, not your wallet, to pay for care. You're just transferring money that you already have sitting there. And so let's just look at how this would work. So we've got, again, both people covered under one contract, joint policy, and we're going to do a $200,000 single premium. So maybe we've taken, let's say, $200,000 of this, a $200,000 CD that's going to be coming due soon. We've used that to buy an asset care policy, and so for this couple, it's going to buy them $244, let's say, of death benefit. Now, that's not a huge death benefit, and that's fine. You know, the reason they're buying this is for the long-term care coverage. If you wanted to get more death benefit, you know, if you wanted to buy a $500,000 death benefit, well, you're probably better off with a life insurance policy. But for somebody that's interested in covering the long-term care, our policies will give you something back in death benefit while giving you a lot of long-term care. Whereas if you buy a life policy, you're going to get a lot of death benefit and very little coverage for long-term care. So this is buying them $244 if they never use it. We're going to buy that lifetime unlimited LTC rider. And this works out to a little over $10,000 per person per month in long-term care coverage that they cannot run out of. So because this is a joint policy, the 10,000 and change is the husband's benefit and the wife's benefit. So they're both entitled to their own. If you had a rare scenario, just to illustrate the point, where both people needed care, we would actually pay out over $20,000 a month. We pay out $10,000 for the husband and $10,000 for the wife. Now, whenever we do that, they always share the pool of money, the total LTC benefit they share. So they have their own individual monthly benefits, but they share the total pool. Well, if we buy the lifetime rider, then the total pool is irrelevant. It's like an ocean. You can't use it up. And so this is the best way to get coverage that we can ensure will be there for both the husband and the wife. And again, you can see from these numbers that, it doesn't take us long paying out $10,000 a month to eclipse, to Wade's point earlier, the $200,000 that we put into it. Right? I mean, it's a year and change, we've recouped all the premium. Anything past that is really gravy for the clients. But that's a very common client that we see, somebody with money on the sidelines. So think about your business. Who do you know in your book of business that has money sitting on the sidelines? This was kind of what the advisor I mentioned. This is what he did. He had some money sitting there, and he said, I'd like to cover the risk, and I'm not interested in paying annual premiums. And he was like, that's fine. This works great.
Yeah, and I think a way to look at it too is look at the death benefit, right? So if they don't use it, they don't lose it, right? They get a $243,000 death benefit. They're made more than whole on the death benefit. So it's sort of like, hey, One America, can you guys hold my money? And if I ever need care, provide lifetime care for me. And if they use it, they get lifetime care. And if not, they get more than their money back. So
that's right.
You can't find a better leveraging tool than this product for that purpose.
Specifically with the lifetime, that's right.
Yeah.
I do want to call just a point out. We do also have a return of premium option. We don't use this as much. Main reason is because it does remove the lifetime benefit when we do it. But just know this is an option. If you have clients that are a little on the fence about giving up that $200,000 and they want to know that they can get it back at any time, we can always add the return of premium rider. And in this case, what it did, it shortened the duration. So if you see the total LTC benefits column, I think I can zoom this in. Nope, never mind. Oh, I messed this up. Hold on. Bear with me. There we go. All right. If you see the middle column where it says total LTC benefits, you'll see it's $889, which is still a good amount of coverage. They just don't have the lifetime anymore. But the trade-off is that cash surrender value. You see it's $200,000 for like the entire time. So if they decide that this is a concern for them, being able to access that money, you can add this rider and you can get all the money back at any point if you decide to walk away. So just know that that's an option if you have clients where that, it's just a little bit too much for them to give up control of that money. Second case study I want to just talk through quick is a couple in their early 50s. So this is Jack and Diane, 53, 51. They're high income earners. Maybe they're small business owners, maybe they're farmers, right? People that have they have a higher income, or they have income that they want to devote to this rather than using assets. Okay, a lot of farmers have hundreds of thousands of dollars in their checking account, but usually they kind of have that set aside for machinery and other things that might come up. Well, rather than using all that money in one fell swoop, we could just do an annual premium. This would be the paid in 95. And so with this option, I'll show you how this works, but they can pay a premium every year, get their coverage, and then keep that bucket of money that they have set aside. They can keep that intact. As mentioned, this is the most common option that we sell now. And one of the nice things is if you're a business owner, and I'm not going to spend any time on this, but just know, if you're a business owner, you can actually get some nice tax deductions for paying a premium on an ongoing basis. So just to give you some numbers here so you can see how this works, we're going to do the same setup, joint policy, husband and wife on one policy, $7,500 a year premium. So you're looking at what, $400 a month, or no, sorry, $600 a month, $700 a month, somewhere in that range, to cover both people for care. It buys them $192,000 of coverage. We bought that unlimited rider, and it gets them $8,000 a month, again, per person for LTC benefits. And if you think about what's happening here, because the 7,500 is eligible for certain deductions in certain cases, the actual cost of the client can be a lot less even than the annual premium. But I love this idea because it keeps their assets intact, and we're just peeling off a little bit of their assets every year to cover the cost of protecting yourself for LTC. The last thing I'll mention, I mentioned 3 clients. I'll just back up. I mentioned 3 clients. The single premium, the ongoing premium, and then the 1035 exchange. Well, I don't have a case study with the 1035 exchange, but the idea is the same. You could do an exchange, and then you could use kind of a combination where you could seed this with a large exchange up front, and maybe that's enough to pay up the single premium. Or you could do the ongoing premiums in addition to your single premium. We have the flexibility to structure them that way. So just depending on the 1035 amount, that can change how that works. So the last thing I'll cover though is our waiver of premium. I think this feature it's so important, and it's just it makes the recurring premium that much more attractive. And waiver of premium is included on all of our policies automatically. So if you've got someone that's doing a 10 pay, a 20 pay, a paid in 95, waiver premium is part of that. What waiver premium will do is if they need long-term care, it will stop the premium payments. Either spouse. So think of it like this. If we at One America are paying a benefit out to the client is not required to pay premiums into us. And the advantage of that is if you do like a paid in 95 and you're only paying $7,500 a year, you can pay your premiums, for, I don't know, 12 years, let's say, need care, and you've paid in that case, $75,000, $80,000 of premiums only, and then you get all this additional benefit. There's no grading period or vesting period on that benefit. So waiver of premium is built in every time, and when you look through what it does for us, what it does is it allows us to have all of the features that we have on the policy anyways. Plus, it gives us that wild card factor that if we need care, we could potentially pay even less for the coverage. I think that's one of the reasons that the paid in 95 has got to be really, really attractive or very common as well. So with that, thank you guys. I see we're a little over the half-hour mark, but I'll just wrap it up and I'll just kind of redirect us back to those 3 clients. If you have any of those 3 people in your book of business, feel free to reach out to Wade, and Wade can show you how this might work with the strategy. So thank you, Wade. Appreciate the time.
Thank you, Greg. And yeah, now's the time to open it up. If you guys have questions, you can pop them in the box on the go-to main screen. It's gonna, on the very bottom, it says questions. There's also a chat box. You can type it in there as well. We have kind of a quiet audience, which is fine, but otherwise you guys can reach out to me and let me know. I help agents with hybrid cases or traditional long-term care. There's a lot of different products out there, but I will say, honestly, One America is my favorite for a variety of reasons. Greg mentioned the waiver premium, the fact that they take qualified money, the fact that they have lifetime benefits. There's so many features that they have available, and especially looking at joint policy with both couples on there. A lot of carriers don't even have that option, so they just have a lot of features and benefits that aren't out there in the industry right now. Looks like we do have a question here. Let's see. I need to get my I need to get my long-term care. I have a client looking for this right now. That's perfect. And you know what? And again, and I will reiterate what Greg said. Think about the clients you guys have. Think about 3 clients that you think are a good fit for this, whether they're they're in business clients that maybe they're thinking about leveraging, or they're the personal assets, people that have personal assets that are just sitting there. They could be leveraging better in a way that's going to help protect those assets should a long-term care event happen. And let me know, and I'm happy to help you guys with that stuff. So what I'm going to do is I'm going to follow up with this and call you guys, see if you had any questions regarding the content. I'm going to send an email also. But if you guys, when you think about 3 clients you have, let me know. Let's talk about some case design. We'll work through some stuff for you guys. Greg, you have anything else to add? And thank you again, by the way. Great job on this.
Yeah, Joe, I just appreciate it, and I'm just happy we can get the word out to help start protecting more people. So thank you, guys.
Yeah, thank you, Greg. And what I'm going to do is I'm going to share my screen here as well. And so you guys will have my contact information. Feel free to reach out. And 1 second here, I'm gonna share it now. If you guys have questions, feel free to give me a call, and I will be happy to help you guys with any cases you're working on. And again, about those 3 clients, let me know. We can work through cases islands as well. Thanks a lot, Greg. I appreciate it. And you guys have a great day. Take care.
Everyone.